Hey everyone, I'm Mike Zajko. This is the Token Warrant, and I'm joined by my co-host.
Hey, I'm Regan.
Regan Bozeman. We have Meltem Demirors.
Hi.
Welcome. And Jason Badeaux, the CEO and founder of Daylight Protocol. Welcome.
Thank you, guys. Excited to be here.
This is another cool DePIN project. I'm sure Jason will have a lot of commentary on the DePIN category because he's student of the game, and we're excited to talk about energy, DePIN, investing, etc. But maybe just to kick things off and do some introductions, Meltem, if maybe a gal that needs no introduction in this industry, but we're going to do it anyway. So if you don't mind giving our listeners an introduction to yourself, and then we'll hand it over to Jason.
Great. Well, thank you so much for having me. I'm really excited to be here in a chat with Jason. I think we have a little bit of a unique story in terms of how we first met and connected and how we've collaborated over the years. But as background, and I'll sort of share a background that's relevant to what we're going to be talking about today. So my name is Meltem Demirors. I've been a crypto investor for almost the last decade. Started out at DCG Digital Currency Group, helped build that firm and, built sort of that ecosystem. Then joined CoinShares about 5.5 years ago, built that business. We took it public in 2021, went through the roller coaster that is being in the regulated digital asset management business, continued to invest out of both balance sheet, structured investment vehicles, and as an angel. But my background, which I think is not uncommon for many people who got into Bitcoin early on. My background's in commodities. I started out my career in the oil and gas industry down in Houston. I'd gone to Rice for undergrad, finished college during the financial crisis, had worked at a trading firm throughout college, starting out on the research side, then trading methanol, ethanol, got into trading Reggies, which were a carbon reduction scheme, carbon credits shared amongst 10 northeastern states in the United States. And then, spent 5 years working throughout the energy space, both in-house at some of the super majors as a consultant with some of the independents, and just got to spend a lot of time working on physical infrastructure, how to finance it, how to hedge it, how to manage portfolios of it. And so, I think that cross-section of commodities and crypto is probably something Jason and I share a bit. So I'll pass it over to Jason with that.
Awesome. Yeah, guys, excited to be here. Quick background on myself. As you mentioned, I'm the co-founder and CEO of Daylight. Like Meltem, started my career in the commodity space. Started my career in investment banking, covering energy and power, mergers and acquisitions, capital advisory across the stack for energy and power companies. Moved into private equity, investing in energy infrastructure and infrastructure service businesses. Specialized primarily in power. Our firm invested all across the critical infrastructure stack, from power to gas to water to logistics. And while I was, investing around power, it became very evident in, 2021, 2022, what everybody's talking about now, but what very few people outside the industry were talking about then, which is the coming strain to power grids from booming demand, from electrification, from AI and data centers, from just broader reshoring of industrial capacity. All of these things were creating tons and tons of strain on energy grids, and building grids in kind of the traditional method of, building power plants in the middle of nowhere, building massive transmission systems to pipe those electrons into city centers. That really isn't going to work for the next generation of expanding our power grids. At the same time, have been in crypto since 2017, just personally met Meltem, experimented with a few different ideas, and at some point saw the analogies between, what Helium was working on and kind of pioneering in the space. And saw potential to take similar concepts and similar ideas to energy and distributed energy and apply them here. So left to start Daylight with my co-founding team, raised from Meltem, of course, from you guys, the Lattice Fund, and a number of other great investors, and have been building this since.
Meltem, that's a pretty gangster background. I actually didn't know you were so deep on the energy side, because you've been tweeting about it a lot over the past year, but didn't realize that was your full background prior to getting into crypto. Super cool.
She's a real one. She knows it.
No, it's so funny because, as Jason said, I think everyone's talking about energy right now, but we've been talking about this for ages. And if I might, I just want to take a little bit of a detour. One of the things I've maintained right now, everybody's talking about DePIN. I think firms like Helium, projects like Render, and others have really sort of led the way and showcased the potential of decentralized physical infrastructure networks, or the ability to sort of disintermediate the need for a lot of CapEx by incentivizing operators of all types, whether they're individuals or more industrialized operators, to run that CapEx for you in exchange for this token incentive. But Bitcoin is really the original DePIN, right? And this is something I've maintained. I know it's a little bit of a weird framing, but I think it's important to the story of how Jason and I sort of initially met and started chatting. Bitcoin really is the original DePIN. And over the last decade, no one in Silicon Valley was investing in hardware. Nobody was investing in energy. Energy was kind of seen as a very unsexy sector. And really the only investors who I think were really looking at energy were looking at it more from a renewables and environmental transition sort of perspective than they were looking at it through like a fundamental sort of VC tech approach. Bitcoin, right, over the last decade has catalyzed a $100 billion dedicated hardware and data center economy. Today, there are over 20 publicly listed Bitcoin miners who command between them an aggregate market cap of around $20 billion, and that continues to grow. Those Bitcoin miners, right, have gotten really good at one thing, and what is that? Operational efficiency, because Bitcoin is really exacting. It is a commodity that has no sort of give. There is a fixed supply. No matter what you do, you cannot produce more Bitcoin than the block reward. So how do miners have to compete? They compete on operational efficiency and on OpEx cost, right? Their CapEx is fairly fixed. Like ASICs, yes, you can get somewhat competitive pricing by buying in bulk or having a relationship with ASIC manufacturers or ASIC suppliers. But at the end of the day, it's really two things. How good are you at running your data centers or managing your outsourced data center providers? And number two, what is your cost of power? And so for the last decade, you've seen this tremendous amount of data center build out across the US grid, leveraging all sorts of unsexy power sources that otherwise were not economic to utilize, right? And as Jason alluded to, a lot of this concept really started with this idea of modular and composable data centers in the form of a containerized data center. Now we're seeing modular composable gen sets or generational capacity coming online, because you can't electrify a data center. There's a meta data center right now that's being electrified by literal rolling trucks that have natural gas power plants on the back of them that plug into either a pipeline or CNG, right? Compressed natural gas getting delivered via truck. They're paying 10, 15, 20 cents to get the per kilowatt hour to get these things online. And so I think, again, it all started with Bitcoin. I think Bitcoin miners really built the foundation for the AI boom. And by the way, NVIDIA benefited massively from the Ethereum mining boom, right? In 2017, the majority of NVIDIA's performance, the majority of NVIDIA's sales that year were driven by the demand for GPUs for Ethereum mining. So I just want to give a big props and shout out to the cryptocurrency industry. We think about it primarily as software bits and bytes, but crypto, particularly Bitcoin and proof of work Ethereum mining, have radically reshaped the hardware, power, and data center economy over the last decade. And I do not think this industry gets its flowers, but without crypto, I do not think the AI economy, the compute economy would be where it is, because we've really pioneered these business models out of this very foundational need and the very fundamentals of how Bitcoin as a commodity operates. So I just always like to start there, give Bitcoin its sort of shout out, because it's a very important thing to understand.
Totally. NVIDIA is like the most successful crypto to AI pivot we've seen so far.
That's a really good and controversial take. I mean, I don't know how Jensen Huang would react to that, but you can see it. There's a really great chart somewhere that shows NVIDIA versus Intel stock price over time. And 2017 was the first year we saw a big divergence between the two. And that, again, it was 100% driven by demand for GPUs from Ethereum proof of work mining, which was driven by the Enterprise Ethereum Alliance, right, caused a run up in the price of ETH from like $10 to $80, I think. So again, crypto doesn't get enough credit, but it turns out that if you let people earn tokens by deploying physical infrastructure, they'll deploy a hell of a lot of physical infrastructure.
You're totally right. When we first became interested in this sector, it was prior to the name DePIN even existing, and we drafted this piece called Token Incentivized Physical Infrastructure Networks. And as we were writing it, we were like, these are all token incentivized physical infrastructure networks. We ended up like restricting it to the ones that I think we think about today, like Helium. But really, like Bitcoin, Ethereum, proof of work, they were all running the same playbook. And now it's just kind of gotten to these other categories like energy, wireless.
I forgot that you guys had coined TIPIN. That's what it was before it was
took off, sadly.
It was, it was like when there was DeFi and open finance, there was a few different like competing terms.
Yeah.
DeFi, obviously. I guess the D always wins.
And they had the first DePIN summit was actually the TIPIN summit.
Yeah, it was.
At Masari mainnet in 2022.
It was good times. Some names don't just make it. We'll work on the next one.
Well, I think maybe Jason should share how we first met, because he was wearing his private equity hat when we met, actually.
That's right.
Let's get into it.
Yeah, we met through a mutual friend, another awesome woman in the energy business who runs a business called Black Mountain, and they do all kinds of stuff. And I think did you go to business school with her, Meltem?
Yep, that's right.
Yeah, exactly.
We were little MIT classmates.
That's right. Yeah. And so when we were looking to explore opportunities in the crypto space, was doing a ton of work around Bitcoin mining, wanted to actually initially SPAC a Bitcoin mining company, a really large one in the Northeast, before many of these Bitcoin miners had gone public. And met Meltem, met a few other big names in the industry, Travis Kling and others, and attempted to put together a consortium of power players in crypto to go launch one of the earliest crypto focused SPACs and take a large Bitcoin miner public. And so that was like the earliest genesis of us meeting. We met through that. That idea died when the SPAC window closed. It closed pretty rapidly, obviously, but we had a bank that was ready to go. They were ready to underwrite the SPAC. We had kind of some initial capital contributors. The SPAC window closed. We ended up shelving that idea, and I went back, put my head down in private equity, and emerged again with this idea of DePIN and distributed electricity, distributed energy. And whenever brought that back up to Meltem, she was totally excited and totally on board.
I still remember where I was. I was out for a walk. I think it was December 2021. And I was walking in my neighborhood, and I got the call from Jason. He was like, "Hey, do you want to catch up? Do you have a little bit of time?" I was like, "Sure, guys." They're like, "We've been working on this energy idea." And initially when we chatted, it was a Bitcoin miner, but then we had also looked at vertically integrated businesses. So taking a data center, a utility, and a managed services provider, i.e. somebody who sold hosting to businesses. Typically, like we were looking at an enterprise player that I was really close to and big investor in. And so we were looking at taking that roll up public. We're like, that could potentially be really attractive because you have all sorts of really interesting operational synergies and also hedging opportunities, right? Where you can effectively control a lot of the dynamics and the economics of how that operates. But Dallas, his business partner, and Jason called me up and they were like, "Hey, so we've been working on this thing, Daylight." And they had a third partner, Evan Caron, who's just brilliant and knows a lot about batteries and distributed energy systems. And we started chatting about it. And at that time, I was really involved in the Solana ecosystem. And I was like, "Guys, you should build this on Solana." And that's I think where the conversation went. Then a couple of weeks later, they came back to me. They're like, "Hey, we think we want to put a round together." I was like, "Great, I'm writing a check. Like, how much of my money can you take?" So yeah, it's been really great.
Just to all of our initial investors, and
I did.
Here we are.
Yeah, I did. I remember that. We had some pretty tense negotiations around that first round. I remember that. But yeah, and I think from there, the ideas really blossomed. I think initially you were orienting a bit more around the idea of VPPs, right, or virtual power plants. And now I think the direction Daylight's evolved it's been really cool to see. It's been so fun collaborating with Jason and the team. And in the investor chat, I'm always posting the weirdest charts and data and battery ideas.
Meltem is active in the investor chat.
It's like, hey, I was reading the International Journal of Energy this month, and I found this. What do you think about
your
this
article? Chime in, Jason, please. Maybe that's a good transition. So, Jason, why don't you tell us the story? I always think it's like interesting for founders within the DePIN category. They're doing something totally different, and then they catch the crypto bug, and they're like, "Okay, this is going to work. Something's going to work here. I can borrow from crypto to fix a problem within my industry. So yeah, like tell us the daylight journey.
Yeah, happy to. So you're exactly right. Exactly what we've been talking about all along. If you give people token incentives, if you issue this new money into existence that is central to a new economy, all of a sudden, really weird emergent properties start to emerge around it. And typically, you start to see large deployments, you start to see an active community, and you start to see really new, exciting markets emerge. And that's really like the general thesis at Daylight is that we are building new markets for distributed energy capacity. And let me back up a little bit, about where we are and what we're doing, why we're doing it this way. So energy is obviously undergoing a pretty transformational shift on both the supply side and the demand side. On the supply side, nearly all renewable energy or new generation is renewable, which is great for decarbonization targets, but not great for grid stability because it's difficult to forecast and it's intermittent. We can't directly control it. And on the demand side, we're moving from a world over the last 20 years where electric demand growth has been flat for almost 20 years at this point to one where electric demand is projected to double in the next 10 years. And so we have a whole generation of utility operators, of grid forecasters, grid planners that have never had to deal with load growth. And now it's coming in a significant amount. And so all this is creating tons and tons of grid stress. And so we need a way to solve this grid stress by effectively creating more generation and finding a way to increase the total capacity of the energy grid. But like I mentioned earlier, building new transmission is incredibly difficult. That's really the constraining piece of the energy system today is new transmission, because transmission is very expensive. It is cross-jurisdictional, meaning it goes across many different municipalities, private landowners. It's very difficult to build from a red tape perspective. And so as we think about, expanding the grid, building new transmission is almost a non-starter. It's very, very difficult, if not impossible to build. And so if we can't build grids in the traditional centralized fashion, we need to find a new way to make energy capacity emerge on our power grids. And what's really interesting is that distributed energy can do this in a really unique way. If you can push generation, storage, and energy management to the edge of the grid, meaning that you're generating and consuming and storing energy at the same place that you're demanding it, all of a sudden you're freeing up capacity on the bigger grid to move where it needs to go. So you're basically creating virtual transmission wires by moving energy generation, storage, and management to the grid edge. The problem with distributed energy today is that it faces basically this market failure where it's very valuable in the aggregate. So if we go out and deploy a ton of distributed energy, it's very, very valuable for energy grids. It offsets all this transmission expansion need. But at the micro level, that investment decision is made by an individual. And so there's lower ROIs, it's more expensive, and there's not really like this centralized market where you can clear energy capacity coming online from all these distributed energy upgrades. And so that's really the problem that we set out to solve. We decided that if we can issue a token to fund distributed energy upgrades, we can, number one, incentivize that behavior. So push more generation, management, and storage of electrons to the grid edge, and then anchor all of that to one central protocol that energy companies can come and clear energy capacity from directly. So they don't have to worry about aggregating these devices. They don't have to worry about finding what devices are where. They can just plug directly into the data protocol, directly into the control protocol, and buy standard blocks of capacity from this distributed energy network, just like you can buy standard blocks of energy capacity from large power plants in the wholesale market. And so that's really what we're up to and what we're doing.
That's awesome. Let's dig in a little bit more. One of the things I think is really cool about Daylight and the team behind it is their emphasis on kind of figuring out the demand side. So there's been this real challenge with DePIN projects, and maybe you can speak to this, Jason, is, clearly people will do things for tokens. They'll do just about anything to earn tokens, which has led to the build out of a lot of supply, which has worked in some cases. In other areas, it hasn't worked so well. So we've demonstrated that. But for you guys, like during the bear market in particular, I think a big emphasis is like to experiment with different business models of, how can we apply this in various places? Because we know the supply will be there when we need it. So can you talk us through that journey a little bit and how you guys approach kind of figuring out the demand side before getting directly to the token incentives and building out supply?
Yeah, totally. And 2023 was obviously a rough time in crypto for really any US-based team and investor. We were all navigating the complexity together. The regulatory environment was very bleak. People were starting to question, like, is this even going to be legal to operate these businesses in the United States? One of our investors did a poll of every US bank in the country, and 0 of them said that they would bank a token issuing organization. So you were effectively cut off from the banking system. Nick Carter's like totally right about Operation Choke Point. Like that was a very real thing, continues to be a very real thing. And, as you're, a startup founder looking around at kind of the world as it exists at that point, your duty is to stay alive at all costs. And so we made the decision, hey, we're going to hold off on launching the token, launching the protocol. And to your point, we're going to go experiment with different business models that build toward our bigger vision of this protocol. And when the time is right for us to go and launch the broader protocol, we'll be able to do so from a much stronger standpoint than we otherwise would. And so last year we launched, the Daylight Marketplace, which basically brings together local contractors of solar, storage, heat pumps, HVAC equipment, hot water heaters, the full electrification set. We go and bring together marketplaces of local contractors. We standardize energy upgrade designs, pricing, engineering, and procurement. And then we contract out the actual installation work to local contractors. And we are doing full scale residential electrification primarily in the Northeast today. What's interesting is that business, that marketplace business, is actually going to be the first purchaser of proprietary energy data from the Daylight protocol when it launches. And so Daylight, the marketplace, will be purchasing data from the protocol on day one to present custom energy upgrades to users, to connect them with local installers that can provide these energy efficient upgrades that also reinforce their earnings on the underlying protocol. And number two, we also have the service provider that will be one of the first companies basically purchasing energy capacity from the network to clear it into markets and trade that power. And so we've built an organization that can do both of those things from day one. So exactly to your point, Mike, we're really looking to just scale the supply side, and we've got the demand ready to scale with it from a very, very early day, which I think is key. If you look at, these other projects, Helium, I think, is one of the other ones that has decided to pioneer the early demand side as well as the supply side with the launch of Helium Mobile 5G, their cell plan. And I think if they were to go back to day one, they'd probably just launch a 5G network, and they'd probably also launch the MVNO at the same time and scale supply and demand in lockstep. And I think that is what we'll see many more of these DePINs start to do, is attempt to build their own demand side player and scale that in lockstep with the supply side.
That's cool. Maybe because a lot of people that are going to be listening, they're going to be curious about how does one get involved. So on the demand side, maybe it's like, hey, I actually want to put a solar in or a battery. Is that the direct path? Is it are there other ways for network participants at various levels to be involved with Daylight?
Totally. Yeah. So we have kind of two methods of contribution, pretty simple: partial contribution and full contribution. If you're a full contributor, you're going to earn significantly more than a partial contributor, but a partial contributor can still jump in and start contributing to the protocol. So to become a partial contributor, all you need to do is connect a single internet connected energy device to the protocol itself, which is done through our app. You can connect a thermostat, you can connect a solar inverter, you can connect an electric vehicle or a battery, and that device will start streaming data back to the protocol, and you'll be able to delegate some level of flexibility over that device to increase or decrease your earnings. To become a full contributor, and we get to the data piece of this network, you need to deploy a Daylight whitelisted energy meter on your building, because that streams real-time data from the building back to the protocol in a really unique way. Utility metering isn't built for the type of applications we're talking about building on top of this project. It's really built for cumulative billing at the end of the month. And so it's not granular and it's not real time. And that's a problem if you're trying to settle and clear energy capacity, or if you're trying to sell energy data to service providers, or you want to build a unique insurance marketplace for property data that has better fire risk underwriting because you have access to real-time voltage data. All these different applications we want to build on top of Daylight need access to this real-time data, and utility meters can't provide it. And so our meters are pretty simple to install. Users will be able to purchase them like they're able to purchase any DePIN type of hardware, connect it to their building, and start streaming proprietary data back to the protocol. And so that's the method of full contribution. Once you connect a device, if you connect a meter, you've become a full contributor to the protocol. Obviously, the more devices you connect, the more you'll be able to earn, because the more flexibility, the more capacity, and the more data you're streaming back to Daylight, the more valuable you are to the platform. So if you're just connecting a thermostat, it's relatively low value. If you're connecting a thermostat, a battery, a solar inverter, an electric vehicle, super high value. And so we want to continuously incentivize people further and further down the stack to move to more and more electrified resources that are integrating deeper and deeper into the ecosystem.
I think this might also be an interesting place to talk a little bit more about DERs more broadly and the broader trend of DeGEN, as we like to call it. I don't know if that's the official name yet.
What's that acronym?
Okay, so DeGEN is decentralized generation or decentralized energy generation. So DeGEN, I think the term was getting thrown around by Ryan McIntosh from A16Z and American Dynamism, who's been looking, at distributed generation. And then DERs, if people are in New York, there's a great DER, distributed energy resource ecosystem. So the word DER has been around for a while. DERMS, DERMS, is distributed energy resource management systems. That's like a smart thermometer, smart thermostat, or any of these devices that allow you to sort of like adjust your energy demand based on a variety of different factors. And basically what this is, DERMS is actually based on some open source protocols that basically allow for balancing of the grid in new and novel ways using demand side response versus supply side adjustment. So kind of thinking through like the power grid, I think one of the things that doesn't get talked about enough is kind of this imbalance between the responsiveness of supply and the responsiveness of demand. If I have a combined cycle gas plant, right? The reason why natural gas has been so popular, number one, natural gas is really cheap right now. Before fracking and before shale, right? It was $12 per million cubic feet of gas, which is standard unit for gas at Henry Hub. Now it's about $1 or like $1.15, which is super cheap, right? And in some places on the grid, in some places in the energy grid here, you actually have to pay to get people to take your natty, right? So this is why natural gas has become a really popular fuel source. You can cycle those power plants up and down in like 2 or 3 hours. A coal plant, you have to run 24/7 at kind of the same load. It takes 12 to 24 hours to cycle up or down a coal plant. A nuclear plant produces a consistent amount of, like, you're not powering up or down a nuclear plant. Once that baby's running, it's running. And then all of these renewables that are on the grid, as Jason alluded to, are intermittent. And the second component is transmission and distribution is becoming so incredibly expensive. Today, if you look at your power bill, I recommend this, everyone do this, go look up your most recent utility bill. It breaks down what is the cost of generation, i.e. the cost that the supplier is charging for the energy it produces that you're consuming. And what's the cost of T&D, transmission and distribution? Today, probably a half to 2/3 of your power bill is T&D, transmission and distribution. And this has been a growing trend. And so one of the things we're seeing in the energy grid when it comes to the supply side, right, supplying electrons to the grid, it's very brittle. It's very difficult to adjust the supply of electrons and to get them to flow to the places where there is demand for them. And then if you look at what's happening, right, with data centers, a lot of that demand from data centers today has not been electrified yet. And if it is going to be electrified, it's not coming from the grid. It's coming from off-grid assets. Right. So this is stuff that's not even part of the grid. This is like the places in West Texas where people are using nat gas directly from the wellhead, where they're using, potentially hooking up to a solar farm that's not even on the grid. It's just purely dedicated kind of behind the meter to powering a data center. Maybe they have a battery array there. So on the supply side, very brittle, very inflexible. And so if we look at what happened with, the innovation that crypto brought to the modern financial system, in my view, it made finance modular, composable. It built systems that were really dynamic and really resilient. So these same ideas we can apply to physical infrastructure, particularly the grid, with things like daylight. Instead of having this really brittle, monolithic architecture that's highly centralized and relies on these massive power plants that then have to push T&D out to hundreds of thousands of homes, you can now have a more modular, composable grid where you have all of these diverse sources of supply, and you give homes as well as C&I, commercial and industrial consumers of energy on the demand side, the ability to sort of modulate and sort of manage their demand and to be more responsive to power pricing so that you consume power at times when there is less demand, right? Maybe it's, hey, you run, your dishes at night instead instead of, during peak demand from 5 to 8 p.m. Maybe it's, hey, you run certain processes or you do the majority of your heavy compute workloads, at night when there's inherently less demand for power. So I think all of these concepts, that we talk about, is just important to remember. The grid is a really dynamic beast. The grid is not an open market, right? ERCOT is the most open market in the US today. ERCOT is the Texas region grid, but there's a lot of different ISOs, which ISOs are basically the governance bodies of these localized power networks. Jason, there's 7 ISOs in the US, right? Yeah, 7 ISOs. It's been a while since my ISO days, the days of trading 24-hour power. You have to be a real degenerate to trade power. Like, the forward curve's really hard to price. It's just the US grid is a shit show right now. And it is my fundamental belief that crypto, and in particular DERs, DeGEN, they're going to be the way that we fix the very broken US power grid. There's a supply issue. There's a demand issue. There's an underlying systems and architecture issue. And then the very last component, which I think is important, and maybe Jason, you can talk about it, there is a foundational markets issue in that power markets today are really, really messed up. It's very difficult to buy and sell power. In a lot of instances, smaller producers can't even sell power. There's a great map a couple weeks ago that someone published that showed in different parts of California the amount of money you would have to pay to put power from your renewables back into the grid. And it was something like $90 per kilowatt hour for a solar producer to put power into the grid, right? So these things they inherently just don't make sense. And it's because the power grid is so archaic. The markets that govern the grid incentivize all sorts of wonky, really inefficient behavior. And there's nothing about it that really makes sense. But Jason, maybe you can just touch on that final markets component, because I think at Daylight, you spent a lot of time thinking through the financialization of proof of capacity beyond just the token, obviously, you're going to have in your network. But maybe you can touch a bit on just some of the opportunities when it comes to building more efficient power markets, because that really excites me.
Totally. Yeah. And I will also want to call out one specific thing you said, Meltem, which is around the T&D costs and the increase in T&D costs. There's some great charts the IEA has. Maybe we can link them in your show notes, showing exactly what you're talking about, the utility bill components of T&D versus generation and the increase of T&D. And that's a big focus on what we're doing at Daylight, is this idea of pushing energy capacity to the edge, what I talked about earlier, because most grid forecasters estimate that we need to spend somewhere around the ballpark of $600 billion annually in transmission capex to meet all the coming energy demand over the next 15 years. That's a massive, massive, massive amount of money that needs to be spent on transmission capex. And in a rational market, right, that should either go to fund transmission expansion or other reliable alternatives, which in this case is distributed energy. But the market isn't set up for that mechanism to work. And so that's where Daylight comes in, where we're stepping in and saying, this should offset the need for all of this $600 billion of capital expansion. And so, in a rational market, that should just fund DERs directly. It doesn't. So instead, we're launching a token to incentivize DERs and anchor it all back to one standard protocol that can then clear that capacity back to purchasers of capacity in the energy market itself. I think if we drill down to a specific example of where this is useful, back to Meltem's comment on market structures, energy retailers are going to be one of the biggest end customers that we work with in these deregulated power markets. And so I think one way for people to think about energy retailers, if they're not familiar in your audience, is to think about them as almost as MVNOs for mobile. Most people at this point in crypto and DePIN are familiar with MNOs versus MVNOs. MNOs own cellular infrastructure. They're AT&T, they're Verizon. They also offer their own services. And then you have MVNOs like Mint Mobile that piggyback off of the existing infrastructure and sell their own plans. Energy retailers are kind of like MVNOs. They still use utility-owned distribution infrastructure, but they buy commodity, they buy electricity in the wholesale market, and then they sell it to customers in fixed contracts. And they are, exposed to a ton of risk because, like Meltem was saying, power is super volatile, but they're selling energy at a fixed contract directly to an end customer. And so they're exposed to all this volatility, and they have to make sure that they are hedging themselves appropriately. And typically that's done through a lot of, financial hedges and derivatives. But what's really unique is, back to the point on energy data, they don't really have a good look at what's actually occurring on their book until a day or two or three or a week after it happens. So they could have blown up and not known it and be exposed to all of these fines and fees and have to cover their losses paying the real-time price that they otherwise, they may not have the ability to pay for. And so one of the interesting things about Daylight as a on-chain capacity market is they can connect directly into our book of customers. They can get access to the data in real time, so they understand, what the customer has and what the consumption is from their book of customers on Daylight. And then they can actually buy blocks of capacity from their own customers to cover their exposure to the market and reduce their exposure if they're short power. So you could assume that you have 100 Daylight customers, they all have a battery. That retailer could see that it's short power, and instead of buying power at the wholesale price, they may have already bought a capacity tranche from Daylight for that hour, and they can redeem that capacity directly from the battery. So the batteries kick on, those customers load, nets to zero, and now the retailer's back on the right side of their book. And so this is like a really interesting kind of new market that we want to build around the protocol, is selling these new capacity and new data to build just more efficient markets around managing energy exposure in general.
We just threw a lot out there. Jason and I have the same type of mental illness where we think this is really
we think it's fun.
Yeah, I send him charts. I'm like,
I feel like I learned a lot. I don't know. It's been super, super interesting.
Yeah, this is one of the deeper, I think, investor knowledge bases that we've had on the DePIN side. Because there's some crossover that any investor has to kind of bring themselves up to speed. But Meltem was already very much up to speed, which maybe is kind of like an interesting transition time. Jason, like, this is called Token Warrant. We talk about the fundraise. Obviously, you guys have been successful there, but you come from a non-traditional background, so you had to think like, well, how do I raise from crypto investors or traditional investors? You meet Meltem, you're going to SPAC a Bitcoin miner. Like, yeah, how did you approach this, and what's that journey been like? Because you weren't an insider, certainly, where you knew all the investors and you could kind of hit everyone up on Telegram and say, hey, I'm raising around.
I can't even name the amount of mistakes I made. Meltem was like yelling at me, like, you have to shorten your deck. You're not in private equity anymore. Like, take all these words off. Like, if there's a mistake to make, I made it. And I think that's one thing I repeat to new founders that are asking me for advice. It's like, it's not the amount of mistakes you make. Like, mistakes aren't going to kill you. It's how quickly you can correct those mistakes. And now that we just closed our most recent round, Mike, understanding all the mistakes I made in the first round when we first met you guys compared to that round, it was such an easier process, such a faster process. And I think just a better result in general, because, I've now learned how to play the game, how to, really build a crypto project. And that just made that, most recent round much, much easier to raise. So to your point, in the first round, I was an outsider. Meltem was my only point of contact into crypto. She was helping me craft a deck, and she was introducing me to tons of investors. And at the time, like you said earlier, there was no DePIN, there was no TIPIN, there was none of this. We were pitching kind of generally helium for energy, and most crypto investors, I think, were largely not interested. They would text me and be like, what are we doing here? And I was like, everybody, how hot DePIN is, and everybody wants DePIN exposure now. But I mean, 2 years ago, nobody wanted to touch it. Nobody wanted to
write a check. No.
And anybody that says that they've been in DePIN for 2 years as an investor, I can tell you that they're lying, because I know what investors were in DePIN 2 years ago. They're almost all lying.
But we love that. We love that.
Yeah.
You're welcome. Come. I think that's another really interesting thing is when Jason started. I mean, your first round, I think, was an incredible round, just considering how few tailwinds you actually had. Like, nobody knew you. You were new to crypto. You were new to entrepreneurs. Like, you had a lot of uphill battles, but I think you raised what I thought it was a pretty impressive round at the time. Really good terms. We had some arguments with investors about the terms. There was one investor that was really trying to lowball you guys and kind of strong arm you. And I was like, we're not doing that. You don't need them. You were like, no, we need them. I was like, no, you don't. They'll come back. Yep. They'll come back. Don't you worry. They always come back. Right.
I'd like to answer the question specifically though, Mike. Like, I think the biggest lesson that I learned in that first round is that if you're having to persuade an investor to your viewpoint or your idea, you're not going to get the investment. You might as well just end the meeting and move on. You need to find someone who already has a general thesis or understanding, maybe not specifically about the company you're building, but just thoughts about the space that you're building in. Because it's like fireworks. When we had our first conversation at seed round, you guys had spent a lot of time on DePIN. You had already crafted a thesis on what makes sense here, what doesn't make sense here. And it allows us to skip all kind of like the boring stuff and get right into a deeper discussion of, does this specific approach in this specific market make sense? And that's, what I would relay is that success in fundraising is about finding investors that already have a thesis and are looking for a team to fill that thesis.
I think I'm raising money as well, right? I'm raising a money for a firm now that is going to invest in things like Daylight and the capital markets that are going to help Daylight, become really successful. It's about finding someone, maybe I'll just expand on what Jason said, someone who shares your view of the world. You don't have to agree specifically on how you're going to get there, but they have to have conviction in your view of what the future looks like, just directionally. You have to be heading in the same direction. The details you can disagree on. And this was a seed stage investment. Daylight has had 2 different names, by the way. And it's evolved so much since that first conversation we had, almost 3 years ago at this point. So as long as you're sort of in agreement on your view of the world and some of the fundamental sort of perspective you have, that works really well, number 1. Number 2, you have to trust and believe in that person, their tenacity and their ability to get it done. I will say in crypto and in every form of tech, hits are not like the serendipitous thing. I know everyone loves to believe in this serendipitous success story. It's not. These things are manufactured. It is a process. There is a factory. You need to know how to do it. There are a ton of different ways to be successful. Serendipity is a part of it, but a lot of it is hard work, preparation, having the right people on board, having the right message, being there at the right time, being flexible, adapting. There are all of these things you have to do right, and finding the right people to work with to help you produce that hit is really, really important. So hopefully I can build a hit making factory.
Would love to dig into that a bit more. I mean, we've had partners from large funds on this show, and kind of understanding how their diligence process works, how they come to consensus is really interesting, because a lot of these firms operate differently. You are you're you, right? Maybe you have a therapist, or I have Mike to kind of bounce my ideas off of. But how do you come to decision making and consensus, kind of operating in a largely solo context?
Yeah. So I would say here, what's really important is having relationships with people who come from radically different parts of the world. I still talk to a lot of my friends who trade commodities. I talk to a lot of brokers. I talk to PE firms who are specializing in digital infrastructure, in energy transition. I talk to traditional VCs who don't invest in crypto, but are interested in renewables, like energy management systems and sort of the adjacent technologies. I talk to all sorts of people who help me QA and sort of sense check. But at the end of the day, I think for me, what I've learned over the last 10 years, my investments that do the best are the ones where intuitively it just feels right. Anytime I have to do a lot of DD or I have to do a lot of work to try to convince myself, those investments typically don't pan out. And anytime an idea seems really obvious and I'm like, oh, for sure, this is going to be a 10 out of 10. No, the ideas that always do the best and the things that always are my best returners from a fund perspective, the things that are really sort of oh, this is I get it, but there's a lot of hair on this, and oh, this is weird. These founders are weird. Not a lot of my founders are consensus crypto success founders or what you think would be successful. They're typically people who come from different spaces, have a different perspective of the world. But I think part of it's who can you talk to get a perspective of the world that is sort of connected to what's happening in the broader macro context? I think for me, especially, I'm not a research driven, I'm not an engineer. I'm not doing due diligence on sort of the technicals of protocol. I'll slide into your GitHub, don't get me wrong, but that's not what I'm bringing to the table. What I'm bringing to the table is the ability to connect what's happening in crypto to what's happening in the world outside of crypto. Crypto's teeny tiny, okay? We need to be talking to PE. We need to be talking to infrastructure investors. We need to be talking to credit funds. When Jason needs $100 million of working capital, right, to inject more infrastructure into his network or to provide lines of credit to homeowners who want to do this, guess who's going to go find that $100 million line of credit from one of the more traditional credit shops? It's going to be somebody like me. It's not necessarily going to be a crypto native investor.
So I think it's sooner than you think, by the way.
Oh, I'm ready. I'm ready. I spent the last week, rounding up the PE folks and figuring out who has that credit line from PIF. So we got it. So I just think there are different things that different firms bring to the table. I think my goal has always been to connect what's happening in crypto. And I would like to think I'm deeply crypto native, but I'm also non-crypto native in the sense that I'm still deeply tethered to traditional commodities markets, to private equity, to infrastructure, deep tech, all of these adjacent ecosystems. And more than ever, if we want crypto to eat the world, we're going to have to talk to the rest of the world. I don't think we always do a good job doing that, number one. And number two, like, history is full of great lessons. There's nothing new under the sun. Everything we're doing has been done before. So I think it's having the humility to go to people and say, hey, I want to learn from you. You did this in the 80s. You did this in the 90s. You did this in the early 2000s. You had this great trade you put on, in this specific asset class, or, hey, you now own the infrastructure in this specific industrial vertical. Like, teach me about that. Help me learn from you. And then we get to take it and reapply it in our world. But there's so much to learn from people who have done these things before. Sure, different technology, sure, different infrastructure, same underlying concept, right? And it's going to play out the exact same way. These patterns are sort of consistent, right? This unbundling, rebundling, tremendous opportunities for credit, commodity super cycles coming. Like, this is not new. We've done it before. So it's going and learning and having the humility to say, like, I don't understand this. I'm going to learn about this, and I'm going to be a dum-dum. Like, I go to these energy meetups and I'm the dumbest person in the room, and it's great. And everyone's really willing to teach me. And then, a year later, they come back to me and they're like, hey, I want to do a crypto thing. So it's also good for sourcing. But yeah, it's a lot to learn.
I think on that note, because we're just about out of time, Meltem, you've shared that you're raising a fund. So any LPs that are on the call, you know who to get in touch with.
No, we're not allowed to solicit on air, Mike.
You didn't solicit. I did. Jason, maybe this is your chance. For people that are looking to get involved, what's the best next step? Who should they be following? What this is your time.
Totally. Yeah. So when this airs, actually testnet phase 1 will be live. It's going live on Wednesday. We're on Monday, the 29th. It's going live on the 31st. And so when this airs, it'll be game on. So to get involved, download the Daylight app. It'll be on the iOS store. Android's coming soon. You can connect energy devices. We have integrations with nearly every energy device that touches a home or small business. 100-something integrations, either in the app or coming. So you can download the app, start connecting energy devices. You can navigate our marketplace and find other energy upgrades to get deeper into the ecosystem and earn more. So solar, storage, heat pumps, hot water heaters. We're bringing together contractors and building networks and software tools to make that super seamless and cost effective. And we'll be, prepping to launch our meter and have the initial hardware drop coming shortly after. So I'd say download the app, start connecting devices, start earning points, and start going deeper into the ecosystem. Follow us on Twitter. I think we're Daylight Energy _ because there is a Daylight Energy on Twitter that's been sitting on the handle for a decade. They've never tweeted. It's some company in the UK with like one follower. Don't follow them. Follow Daylight Energy _ And we're excited.
And then to follow you, what's yours is how do they follow you?
Oh, you can follow me on Twitter at Jason Badeaux. If you can figure out how to spell my last name, Badaux, then you can follow me.
Wait, Jason, are you from Louisiana?
Yeah.
Okay, I knew it.
Yeah.
You got that. You got that French last name. Yeah. That Creole name.
That's right. It's a giveaway.
It is.
Not
everyone's from the South, right? So
I know
we gotta give them the assist.
This is definitely a non-traditional location for a crypto founder. I think
SEC crypto founder is very minimal. Yeah.
So actually, who is it? Movement Labs. I think those guys went to Vanderbilt. I think they might be the only other.
That's like really an SEC school. I mean,
but hold on. I want to give a shout out to Rice, Brian Armstrong, fellow Rice alum. I was the Rice Owl. He's a Rice Owl.
That's right.
Jaron Lukowitz from Coinsetter, fellow Rice Owl. We've got a lot of.
My dad, not super involved in crypto, also Rice Owl.
Let's go Owls. Proud shout out there. And then there's a lot of A&M folks. There's a lot of UT folks. In fact, there's a professor at UT who has a great sort of like crypto lab. And I would say he's producing impressive economic outcomes, sort of comparable to the ones being produced up north at Princeton. So I wouldn't write off the South. If you're excited about DePIN and particularly DeGEN, you got to get down to Austin.
Yep.
Dallas, Fort Worth, Houston. There's a lot of interesting stuff happening.
You hear to hear first. Next conference, we're heading down there. I actually think the best thing about DePIN is that it's not just crypto people. We should be pulling in people from other industries or going to their conferences and talking about what we're doing. Anyway, we'll leave it there. Meltem, Jason, thank you. This is one of the best episodes, if not the best we've had. So really appreciate it. Thanks so much.
Thank you.
Yeah, thanks for coming on.
Go Daylight.
Go Daylight.